Hi, and thank you for joining us for the first quarter market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strege. Overall, we have good news to report this quarter. So far, the U.S. stock market rally that began last November has continued, with the Russell 3000 stock index up over 9%. However, we have seen some negative returns year to date in a few asset classes, including real estate and the bond markets, as interest rates have actually climbed a little bit since the beginning of the year. The Bloomberg U.S. Aggregate Bond Index is down a little over 1% for the year. We are recording this a few days before the end of the first quarter for full disclosure, so the return numbers could change a bit. There's an old saying in the stock market that says, as goes January, so goes the year. This is also called the January Barometer, and there is some evidence that backs this up. Since 1926, the S&P 500 index has had an average annual return of 12.7% during years that included a positive January, while the market has only averaged an annual return of about 7.6% when January has had a negative return. The market had a positive return this January, so let's hope this does turn out to be a good barometer for the year. The stock market is still being driven by tech stocks, including what is known as the Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. These 7 companies currently make up close to 30% of the S&P 500 stock index, and they were responsible for nearly 70% of the stock market's return last year. Growth stocks, led by the Magnificent Seven, outperformed value stocks by over 31% last year, which was the third largest margin in nearly 50 years. While these are good companies, it can be difficult to repeat that type of performance. Typically in the year following this type of large outperformance, the market swings back the other way and value stocks do better. And we would expect that to likely happen this year. Inflation and interest rates continue to dominate the headlines and remain one of the primary focuses of many investors. There was mixed news on that front in the first quarter. While inflation has moderated at a little over 3%, the inflation numbers reported in January and February were very slightly higher than expected by about 0.1%. While the stock market was largely unfazed by this, it caused the interest rates to rise a bit and bond prices to fall. At their March meeting, the Federal Reserve indicated that they still expect to lower interest rates 3 times this year and for rates to steadily drop over the next few years. However, bond investors were concerned the pace of rate cuts could be slower than initially anticipated. We still remain optimistic that the bond market will do well this year as interest rates eventually drop. While many investors have stashed cash reserves in money markets, offering rates over 5% in some cases, these rates can drop rapidly as the Fed makes cuts. On the other hand, bonds tend to get a price boost and do very well when money market rates are dropping. Since 1976, U.S. taxable bonds have averaged a return of over 12%, when cash yields went down 1% or more in a calendar year. Therefore, we are starting to recommend that investors deploy some of their cash into bonds and consider extending duration a bit with the goal of picking up more price appreciation as rates drop. Overall, we remain optimistic that a relatively healthy economy, backed by strong consumer spending and dropping interest rates, will provide a backdrop where both the stock and bond markets can perform well this year. As always, we will continue to monitor the markets and keep you informed as conditions change. Thank you for your continued trust, and we look forward to having a meeting with you about your investments very soon. Take care.